All children are
Hi guys. Dave's just he's launching already into his he's on his soapbox, and I had to get him off before he can start the podcast, and so he can get back up to talk about this.
Yeah.
So what we're discussing today, I've actually got the wrong headline up. I'm sure I've got the right slides there. Let me just check. Yes, I have. Is are we headed into? So we had a big drop in a lot of the tech stocks last night. There's a lot out in terms of talking about the problems with AI, and I guess the big question we're asking is the AI boom over? So I've got our Gartner hype cycle chart up that we've shown a few times, and I guess the question is are we headed down the other side of this peak of inflated expectations, or is this just one little bump on the way up, and this is your chance to another chance to jump in? So with that in mind, I just want to highlight as well, anything here today is general in nature, and any advice, and that if you do have any personal needs, you can check in with us, give us a call, pop us an email, and we can have somebody talk to you and talk about your own needs. But with that aside, I will bring in Dave. Dave, how you going?
Yeah, good. Thanks, Damien. How are you?
Good. Yeah, not too bad. Not too bad. So we've got this Gartner hype cycle up. Last time we spoke about it, and we said, look, we still think we're on this path upwards. And overnight, I guess, if you want to give us a quick summary of, I guess, the way you're seeing what happened overnight.
Yeah, sure. Well, I mean, there's lots of people blaming AI, and of course the mega cap stocks are the ones being hit hardest because that's where the market concentration is. But I actually don't think this is an AI-driven correction. It looks to me more associated with political and macro uncertainty, which is, not a good combination with a highly concentrated, high-valued stock market, right? So we've had the American election brought forward by months because of the assassination attempt on Trump and the retirement of Joe Biden, which has destabilized everything. You've got, definitely got a Trump trade working its way through all sorts of markets, and that's not very, at least in its initial stages, not terribly friendly to mega cap stocks. Like it's inflationary, it's high US dollar. Excuse me. These are not, kind of typical duration macro environment. It's not a duration macro environment. And then you've got the Fed piling in with cuts any minute, probably not in this month, probably in September, but it could go sooner and spook everybody that growth's worse than they thought. But it's certainly going to go, and that's kind of got some internal rotation stuff going on in the stock market as well. Though I don't really subscribe to the rotations that are underway, but they are there. And so you've got these various uncertainties that have landed on what is, without doubt, a very unbalanced stock market, highly concentrated in mega caps and expensive. But if this was to be the peak of inflated expectations, then I would put it to you that AI is a complete bust.
Yeah.
Because this is not, it's bubbly now, but it's nothing like, really tear away, frothy, like new permanently high plateau kind of like revolutionary stuff. It's just not that overvalued. So, my base case is still that this thing will probably get bigger, but for the time being, it isn't. And of course, I could be wrong. I could be wrong, and there'd be downside risks.
Yeah, and the other thing is most of the valuation, certainly by market cap, is in companies that are actually tearing it up on the earnings front and getting good growth. And so I guess it's a question for, as opposed to the last time around, I guess, the tech boom we saw back in the 2000s when that was bubbly was, people who didn't have any earnings were the ones that were
That's exactly right. So, and I wouldn't argue that it's not expensive. It is, but relative to the bubbles in tech that we've seen before, this is so minor. That and narrow that I'm just, well, yeah, it's bubbly, but God, it's not your grandfather's bubble. Anyway.
No, that's right. Well, I don't know. I don't know how old your grandfather is, David. Or how old do you think our audience is?
But, I don't know. Let's just take that as a phrase. Let's not labour the metaphor.
Sounds good. Okay, so I've got this. I've got this chart. I'm going to pop up. Actually, I better get that on full screen. Just to show NVIDIA's earnings, and this. So I just wanted to highlight. I guess the main thing I wanted to highlight on this one is this idea. Look, is NVIDIA's earnings starting to slow down? I've got this red line, which is the next 12 months. The blue line, which is the last 12 months, and then each of the individual years are the sort of the small numbers, the individual numbers going up, and so the next 12 months basically takes, at the moment, NVIDIA's got a weird sort of reporting where they've already reported their 2024 numbers, and we're talking about the 2025, but it's effectively taking from a calendar sense, you're taking half of 2024 and then half of 2025, sort of going into your next 12-month numbers. And so they're still climbing. The growth forecasts, what's most attractive with charts like this is that when you're looking at the future years, those future years are still climbing because what you often see in companies, and I'll show you the same charts for the whole market where you see it all the time, is that there's this expectation of like, okay, they're going to do whatever, $3 next year in 2026. And then what happens is that just progressively gets, and that might be, that might be like 30% growth, and they don't end up hitting that. They might end up with $2.50, which is still a big increase on where they are today. But the earnings, the actual amount of growth gets downgraded over time, and that's usually what happens with a lot of, well, when that's happening, that's when I start getting concerned about trying to track, are we coming to the end of the growth? Whereas when we're seeing continual upgrades to those numbers, that's where you're less concerned about the growth and have we reached the end of that? So yeah, so earnings still definitely booming there for NVIDIA. If you jump to their, if you look at the Capex side of this, and so what I've got up here is just a chart of what they call the hyperscaler Capex, and really I've just pulled it back to the top four. So Meta, which is Facebook, Microsoft, Google, and Amazon, which make up about 2/3 of the market. Well, the guess is about 2/3. It's it's hard to know exactly. And the lines in that, it might be a little bit small, but the last line on the end of that chart is the what's expected for the fourth quarter, what the sort of guidance is for the fourth quarter, and that's looking about $55 billion a quarter by that point. First quarter numbers were probably more like 35 to 40 in terms of those. So if you look at it from sort of that perspective, by the fourth quarter, we're going to be closing in on sort of $350 billion of Capex annualized going into data centers, if you take into account the other players out there as well. NVIDIA is, if you sort of then look at the forecast for what this Capex is going to do over the next 2 or 3 years versus what the forecasts for NVIDIA are, NVIDIA is actually growing slower than the forecast for the Capex. So, if you look at sort of its revenue as a percentage of all the Capex, you sort of go, its revenue on data centers versus the Capex at the moment is probably about 38%. So you're basically going for every dollar that's being spent on this hyperscaler Capex, 38% of it's going to NVIDIA, but that's actually falling over the next, in terms of forecasts over the next little while. So, I guess what I'm coming to is, yeah, look, there's some pretty good growth numbers factored in for NVIDIA. but they're not sort of off the scale in terms of, and you're not ending up with this weird thing where sometimes you do in particular sectors where, you have a company that's forecast to grow at 30 or 40%, but the whole sector is going backwards or sideways, and then there's this mismatch with sort of when you look at it from two different directions. But I guess what I'm saying is when you look at it from their customers and what they're expecting to spend, and then when you look at it from NVIDIA and what they're expected to make, the numbers don't sort of look like NVIDIA's like wildly optimistic, based on its sort of market positioning and everything at the moment. So then if you jump to NVIDIA and say, well, what about the valuation side of it? Look, it's expensive. This actually doesn't include last night's move, so you can sort of take 5% off this. So you're sort of in the high 30s in terms of your price to earnings ratio for the next 12 months, which is up there, but it's not. It's actually that's the red line on this chart for anyone, the top chart. Anyone listening in? Oh, sorry, watching on YouTube. But it's basically for anyone listening in. It's in the high 30s is sort of, if you look back over the last 10 years, it's about average for it. And if you look at the yellow line on this chart, which is the second 12 months, so saying don't just take the next 12 months, go from the 12 months to 24 months. It's towards its bottom end of the range if you look at it from that perspective. And then the bottom chart's just sort of showing where does this sit versus the market as a percentile. And so it's sort of roughly at the 90th percentile, which is largely where it sort of sticks. It very rarely goes much below that. So I guess it's in terms of a pricing multiple. Look, it's expensive, but it's not sort of off the charts expensive relative to where it's been. I guess the flip side is it is a much larger company now than it has been in the past. So it is harder to get this sort of growth. And then the second part is just noting that actually, if you look at it on a cash flow basis, which we tend to do a lot more within our numbers, now it's back at the 80th percentile. It actually looks cheaper on the cash flow basis than it has for some time. So on a cash flow basis, it's actually and ends up looking. I mean, it's still expensive. The 80th percentile is in your top 20%, or it's at the 78th percentile, it's in the top 22% of companies. But you would argue that it is one of the best companies out there, and so it deserves to be in the probably at least the top 10% on that basis. So so that's NVIDIA just broadly. If you look, the other thing I just wanted to highlight as well is the earnings we've seen so far for the market are actually pretty strong. Now you're going to see downgrades and upgrades from various companies, and there are some pretty hefty numbers sort of factored in. But I guess what I wanted to highlight is I've got a chart sort of showing similar to NVIDIA, except this is for the entire market and going back again sort of 30 years. And the red line on this one is the key, is that forward forecasts, and the blue lines are sort of the individual year forecasts. And so and that's where I was talking about that pattern, as you can see with the blue lines, is they generally start high and then work their way down to the actual number. And that's what you've seen, pretty much right throughout that whole period. There's the analysts are too optimistic at the start, and then they eventually come back to more normal numbers. But actually, as long as that red line keeps going up, you don't really care. You don't care, but that if an analyst is factoring in 15% growth and it comes in with 10% growth, it's actually still a good outcome. You're still up 10% on where you were the prior year. But the key thing I wanted to focus on is that very last, right at the end of that very last line you can see, the blue line, is what's expected for 2024. Now, that has been stable, and usually by now, halfway through, you would have, if that was going to fall or certainly be downgraded significantly, you would have probably seen that happen already. And so unless we sort of see a sudden shift in the second half of the year to some pretty drastic falls, 2024 numbers actually look like they're going to hold up pretty well. And the second quarter in particular, if you strip out the largest stocks, so you strip out the the tech stocks that have been giving you most of these gains, the earnings were really bad for most other stocks. It was sort of negative 5%-ish for the last, I don't know, 18 months, say. Every time you're looking at quarterly earnings, they're down sort of 5% or so. This quarter, they're looking like being up 5% for other companies. So it's actually a pretty reasonable turnaround in stocks. So it's obviously not great growth, but it is a sign that this earnings weakness we've been seeing for the last 18 months is very much coming to an end. I mean, it could still surprise, and something could happen towards the end in the next part of the reporting season. But really at the moment, that's not the case. And just finally, I've got one more chart which shows that same market fundamentals. This time it's cut. It's the same one, but just shown as a growth rate. And so you can see that from this one, we've got a whole bunch of different lines. Each line is a year going back in time. And basically, you can see analyst forecasts start at 10%, and then they break one way or the other. They either fall or rise in the following year. So we've actually seen, so 2024 numbers are still at 10% and this is S&P 500, sorry, so just the US. So it is more dominated by these larger tech companies. But 10% growth is pretty good as an historical earnings figure. So if we come in with that, that would be a great outcome. And by now, as I was saying, you were halfway through the year. If it was going to be lower than 10%, if it was going to be significantly lower than 10%, then you'd expect to see it already. And then 2025 numbers are up to almost 15%, and they're growing in terms of that growth rate. Now, I don't put heaps of stock into that just yet, but it's certainly it's worth noting, I suppose. You don't typically see that that much excitement this early. Usually the 2025 sort of sticks at the same figure for a while, and then as we start in another 3 or 6 months, then that's when you usually start to see it sort of break one way or the other, higher or lower. But that's a relative. It's either a good thing or a bad thing, I guess. It's either a sign that earnings. There is actually some genuine earnings bottoming coming through on the non-tech stocks, and that's going to start, feeding back through into valuations, or it's just that analysts are wildly optimistic for next year and they're going to have to come down. So it's could be either way. But I guess the thing to note with both of these is you're looking at 24 or 25. That's 25% earnings growth you're looking at over that period. So valuations themselves can be high. But if you've got sort of, if you get anywhere near that, say it doesn't come in at 25, it only comes in at 20. So now we're looking at earnings of 21.3. Market valuation 21.3, which is sort of well above average. Is if you do get that type of earnings growth, then prices could go sideways. If you've got that earnings growth, that'd bring you back below average. Just from that earnings growth, if you see it. And then the next part to that is, yes, it's sort of high, I think, these numbers, but again, if you do go into more of a tech boom, there is still probably 10-15% you would expect to be added to this number, and in a more extreme scenario, you could see 30% added to that figure. Would take you back to the sort of levels you saw in the tech boom. But I'd say if it is a genuine tech boom, sort of boom within that sector, you'd expect to see at least another 10% on that figure, sort of bringing you up to above sort of those post-COVID peaks and halfway to where you got in that original tech boom. So anyway, that's the fundamentals. Might sort of throw back to so we should jump to a quick sales message, and then we'll come back with Dave and talk about the macroeconomics.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
So that's given you a sort of rough guide of where we're starting from. And now the question really comes down to saying, okay, well, what is AI going to deliver on a productivity basis? Because that's really, I think, where the complaints and sorry, you'll have to remind me the guy's name, Dave, that wrote the report that sort of...
Acemoglu,
that's right. It's bouncing around, and which is basically saying, we're just not seeing the productivity gains from AI at the moment.
This is why I sort of think we're not really seeing an AI correction, because I think it's a kind of preposterous question 18 months in. ChatGPT only launched at the end of 2022, and people are looking for an ROI on the data center Capex. I'm like, well, did they really look for an ROI on railways 18 months in? Like, it's or the internet.
Or the internet, yeah.
Like, it's it's a 5 to 10 year story, which may mean, and there's a sequencing issue here as well, I would say, because although right now it's all about the mega caps and the hyper, sorry, what do you call them? The hyperscalers who are building the data centers and the infrastructure of this thing. The real macroeconomic upside is in its deployment, not in the architecture of it, but in its implementation across every business of scale worldwide, if so applicable. And so, that's where you'll see the productivity gains, and that's going to take time.
Actually, Dave, I'm just going to bring back that chart, the Gartner hype cycle, which is effectively saying, that first peak is really where you're spending lots of capex and all that type of stuff, and the disillusionment it comes because of exactly this reason: is I spent all this money on the internet and I couldn't fire all my tellers yet because I haven't got enough people using banking and it doesn't quite work right and all that type of stuff. And it's not until people start using it and then you get that productivity gain.
Exactly. And what is, I suppose, a bit peculiar about it is I don't think we've seen, it's been so focused on the mega caps that are the architecture of the thing, that the rest of the stock market is not on a high valuation. And yet that's probably where most of the profit gains will ultimately be once we get there. But then that's just the nature of today's economy, I guess. We're coming out of COVID, high inflation, and as Damo has said, there's no profit growth anywhere else right now. So in a sense, what we're really seeing is the expression of the cycle meeting AI rather than AI itself. So I can't say whether the mega caps have peaked and this is the top of the, Damo's opening chart. It might be, it might not be, I don't know. But that's a separate question to what AI can deliver to profits over the next 5 to 10 years. So I thought we'd quickly go through and look at Acemoglu's stuff in a broad sense and have a bit of a discussion about it. Darren Acemoglu is a very well-regarded sort of, I think he's at MIT in the States, it might be somewhere else, economist who modelled the effects of AI in a macroeconomic sense. He used a bunch of existing studies, Alundu et al., which had proposed that roughly 20% of jobs are at risk, and so 20% of simple tasks, more or less, could be supplanted by AI. Then took Thompson et al. That only, in the deployment of the technology, only 23% of those jobs would be cost effective to replace over the next decade. And that brings you down to, just under 5% of tasks being impacted, either being made more efficient or substituted with AI over 10 years. And that gives you, like 0.66 productivity gain and about 1% GDP gain over 10 years, which is not irrelevant, but it's not, like the boom everybody's looking for. He also had a relatively low estimate for cost savings where AI can be deployed, 30%. Others have estimated more like 60. Excuse me. So at this point, not that there's a flaw in Acemoglu's reasoning. His modelling is rock solid, and that's all fine. But it is modelling, and it is temporal, to the extent that it's stuck in time. And he did admit that he does not see AI evolving much over the next few years. He does not use, the kind of technology development curves that we see in things like semiconductors and elsewhere in computing, what have you, in terms of, doubling intelligence or speed or functionality every few years, et cetera. He's basically used a model of AI as being relatively static and using that deployed over a 10-year span. So that's probably the major hidden assumption in his model, which I think makes his reasoning a little bit circular, because we all know AI has problems at this point, not least hallucinations, etc. But to assume that they won't be ironed out and it can't evolve, that strikes me as, overly conservative, shall we say. Not that I'm a super tech whiz. It just strikes me, having used this thing in various forms, it just strikes me as something that has the potential to develop much quicker than Acemoglu's modelling suggests. So,
and a big part of that, I'm not sure what he factored in for driverless and transport.
No, this is purely AI. So, like, we've got a point in here. We've been operating on this thesis for the last sort of year or so, I guess, of AI converging with driverless cars and weight loss drugs to deliver a productivity boom.
But I mean, driverless cars as well. I guess what I was getting to on that is driverless cars is AI. Like, it's recognizing. Yeah, it's a system recognizing what to do, and then what these are the rules when this happens. And I guess all I'm saying for that is, I think it's about 10% of the workforce. I think it's over 10% of the workforce is involved in transport in the US. And so if you said 4.6% of tasks impacted, if you said half of those transport jobs are going to get impacted, you're like, well, that's just that alone. Transport on its own,
that's crazy.
Probably makes up that. What do you
educate? I don't know, what is education? I know education in healthcare and basic kind of public services are like 30%. I don't know what education is of that, but it's probably between 5 and 10. And I mean, if you've plugged anything into AI and asked it what the answer is in terms of basic pedagogy, so whatever the subject is that you want to learn, it can teach you better than a teacher, without question. Like I've put my reasoning into the thing, and it has dismantled it in a way that no professor I've ever had was capable of doing. So it's education's another one I can see absolutely getting completely taken over by AI. So I mean, I think his modelling is uber conservative, and it's very easy to create much more aggressive outcomes where AI penetrates quicker. And so I'm not. I still subscribe to the original rollout model that Damo's got in his initial chart, but I guess what I'm saying is I think markets are missing the bigger story for the time being anyway, that this is revolutionary for everybody, not just the mega cap stocks. And so...
I'd argue that markets have factored a reasonable amount of that in already.
A little, but not really. Like if you look at, like, the ones that are going to benefit most are services firms and whatever, through cost savings and efficiencies, etc. Their multiples aren't up like that. Anyway, that's my argument. Now, so we thought we should take some time to look at another part of this is nobody's really looking at AI as being able to substitute sophisticated tasks at this point. And that kind of is about the philosophy of AI. Like it has it is argued no a priori epistemology. Like, I'm sorry about all these bloody words, but basically what it's saying is it doesn't have a pre-existing framework from which to make judgments, and so its reasoning is inherently inductive, which means based on experience, which brings you actually back to the old black swan problem. You can only if you've only ever seen black swans, you can
White swans.
Sorry,
White swans. Yeah,
that's right. You assume no black swan. So there are limits to inductive reasoning, but I just and then people ask, well, is that problem resolvable by putting more data into the model, into the large language model, to produce the next word in a way that gives you reasoning and deduction? My experience of it is that it is in there already. I don't know how it is corralled or focused let's say into a particular industry, but it seems to me that again, that is an overly reductive view of it. I see deductive reasoning in it already. As I've said, when I plug my reasoning in there, I can pull it apart better than anyone I've ever seen, which is, just staggering. So I can't see why that can't be deployed into, limited frames of reference where you can teach it to be deductive, at least within, accepted points of reason.
Yeah. Well, and also as well, there's parts. So if you took driving as the example, it's
exactly,
there's a certain part to say, well, do you need it to be deductive, or do you just need it to have covered all these different scenarios? And if this happens, then do this. If
that's
then,
right,
do this. And
I mean, yeah, that is inductive, but you don't need it to reimagine the motor car.
No, that's right. And I think
at
the
drive
moment,
the car.
yeah, I think at the moment the reasoning is largely, if something happens that you don't understand, then stop, which is a pretty a pretty reasonable outcome, I think, for most errors.
Yeah.
And then it's the question now of saying, okay, well, here's something we've never seen before. We need somebody to teach it what to do under that scenario, and then
I mean, to use an analogy, it looks like a child. Like kids are always inductive, like they reason from their immediate environment and their experience. They haven't got the broader horizon yet, or the for that matter, cerebral cortex fully developed to deduce stuff. But they develop it over time. And I mean, I just think that AI will go that way. But as you say, in inductive reasoning can get you an awful long way anyway. And I mean, just to sort of leaven this debate, like there's no actual real resolution in these debates, even for something as basic as in human knowledge, in something like science. Like, there's an ongoing debate about the philosophy of science and whether it's deductive and inductive,
Yeah. Well, and then the other part then is most of the jobs you're looking to replace anyway. So, pick a retailer as an example and you say, okay, what are we looking to do? We're actually looking to either pack the shelves more efficiently because, it can work out what's missing and, highlight things and it's a picture scan and all that type of stuff like that. Well, actually, that's not a job you actually needed to be deductive anyway. You just needed to be, if we're missing this object, put it on. And then the whole scan, can we pre-scan things and, work out what people want to buy and all that. So I don't need as many people working checkouts and, there's all that type of stuff where it's like, well, again, we're not asking, you're not at the stage where you're asking it to work out work out run your entire store on its own. It's actually saying, well, let's get rid of all of the inductive jobs first. And there's plenty of scope.
I mean, another great example. I know someone who worked at supermarkets who was saying, in the early days of deploying their AI at the counters, that they'd never sold so many carrots.
Yeah.
Because everybody was ringing up mangoes as carrots, but not anymore.
Yeah,
like carrot volumes have dropped away.
Yeah, that's right. It's now
because the AI, like, inductively learned that a carrot is not a mango.
Yeah. Yes.
So, yeah.
Well, and was taught this is your this is the thing. So yeah. Anyway, so that's so we go to the next one, or are we looking for then the societal change? No.
Well, we can breeze through that quickly. I mean, it's just jobs will be lost. Yes. Short-term bad, long-term good. Yes. Productivity gains and what have you. Although that will come down to policy.
Yeah, actually, I should speak on this one. So this was just this idea that if we took farming as your example, is you go, okay, whatever it is, 80-90% of people are farming a few hundred years ago, and now there's hardly any people farming, and the numbers are still falling. Is that in the long term that's very good for society? Is that we've got less people doing it? It's the problem is when the speed of change, if that happens, all of a sudden you've got all these farmers who all of a sudden are no longer needed overnight, and they're like that, and they'll have a job. And it's sort of similar in terms of, okay, if we don't need a bunch of people driving, packages around or even people around, then that's, in 10, 20 years time, that's good that we've got less people doing that job and more people doing, higher level jobs. But if all of a sudden you have 5% of your employees, 5% of the because there's 10% of people working in transport. If all of a sudden half of them lose their jobs to AI drivers in a 5-year period, that's a big deal for politics. It's a big deal for economics and all these other factors. And so so it's the speed that's going to be the danger in this, as opposed to the actual sort of job losses themselves. And then the question then sort of goes back to, okay, does that mean, do we end up with more inequality from this? So do the people who are running the AI and the supermarkets, for example, when they don't need as many staff, do they take that all in profit margin, or do they actually end up, is it all competed away? Do you end up with this, have you got competition policy and you don't have oligopolies? And so, great, supermarkets have just lowered their cost base by 10%, which means they can cut all their prices by a similar amount. Or do they just keep, they cut their prices by 2% and make much higher margins? And that will make a big difference in terms of the macroeconomic side, in terms of whether you're whether this ends up being sort of more of a deflationary or and whether whether you get more inequality out of it and more this sort of more similar problems to what we've seen over the last or over the 2020s or 2010s. Sorry, does that make sense, Dave? Or is it?
Yeah, it does.
Yep. So we might just jump to a quick sales, and then we'll talk about the investment side.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right, so on the investment side, we'll just quickly touch on it because I think that most of this has sort of been largely about the investment. I think there's what I would say is, first of all, if you think this is just a buying opportunity and you want to sort of top up yourself on this, we have tilts on anything that's sort of running on interactive brokers. So anything that's not personal super, you can add in specific tilts into large technology stocks. We've obviously got holdings in our own portfolios towards this, but if you want more of some of these themes, you can add it yourself into the portfolios. From our perspective, I think we're treating this as just a bump along the upward cycle, and you're going to get these continually as we go through this. It is worth watching in case it turns into something more concerning. But for the moment, I guess our take is that there's the fundamentals haven't really changed. It's more of a macroeconomic uncertainty, as Dave was talking about, and so we're largely sticking with the positions and using some of the. If we see stocks that have come back a bit far, we're using chance to top up on some of those. But it's you typically get these in any market rise. There's considerably you get dark down days, and even if you look at something that's really been hit, like CrowdStrike, which has really been hit from its sort of outages and everything like that, it's still actually well up over sort of over a year's period or something like that. So you're talking about it's erased the last 6 months worth of gains, but still doing well on a much longer term basis. And I think that's the case with a lot of these stocks. Is that the trend is still upwards for most of them, and certainly the earnings trend. And now it's just a question of settling in for the price. Dave, I guess for you on the macro front.
I don't want to underestimate the possibility of a decent correction. I think we're probably in for one. But again, I would say it's a combination of the circumstances with the high value or with the concentrated market. Like, I don't think it's particularly the concentrated market. So that said, I don't see the uncertainties around growth coming out of the US election and Fed movements going away in the near term. So for obvious reasons, we're not getting to the election until November. So I think volatility will be around for a little while.
Yeah. So using chances to as markets pull back to top up on equity holdings. Yeah. Excellent. Thanks, Dave. So just want to remind everyone, if you do want to get any of the Nucleus info, you can see all our stuff on all the major podcast platforms. You can we're on Apple Podcasts, Spotify, most of the minor ones as well. We're on live every Thursday at 12:30 if you want to jump in and ask any questions. And thanks for everyone tuning in, and we'll see you all again next week.